it's my pleasure to introduce our speakers for the day. Our format is a Q&A interview, and our interviewer today is Alison Loat, Managing Director, Sustainable Investing and Innovation at OPTrust. And she's going to be interviewing Ted Maloney, who is CIO and Global Director of Research with MFS Investment Management. And I'll pass things over to Alison to get us started. Over to you.
Well, thank you very much, Caroline, and thank you, Ted, for being with us, and to everybody on the phone. Happy Monday minute, I suppose, lunchtime. Well, we'll dive right in knowing we just have half an hour. And as Caroline said at the beginning, we're happy to take any questions. So I'll sort of plan to talk for, grill Ted for about 20 minutes or so, and then we can leave lots of time for any questions that you all may have so that we can wrap up by about 12:30. So Ted, first would love to just kind of start with a broad question. I think anybody on this line knows sustainable investing is an evolving field almost every day, and all sorts of organizations are on their own kind of journey, so to speak. MFS has had a responsible investment committee and function, as I understand it, dating back over 11 years now to 2009. So curious if you can tell us a little bit about MFS's journey, sort of the impetus to start, how your approach has evolved over the last decade or so.
Sure, thanks very much. Yes, we created the Responsible Investment Committee in 2009, but in some ways we think we've been on this journey maybe since 1924 when the firm was founded to bring diversified portfolios to the average investor through the creation of the mutual fund. And I mention that because we look at sustainability as core to what we do, and a lot of what we'll talk about today, Alison, will be the tools that we and others are using in order to get better at this for our clients and for our world. But so yes, if you want to talk about sort of where the current language around sustainability and ESG started to take hold more officially at MFS, we created the Responsible Investment Committee in 2009, really as a precursor to becoming a signatory of the UN PRI in 2010. And then in 2013 was another pretty pivotal year where we hired our first ESG focused research analyst, a gentleman named Rob Wilson, who some of you may know. And the critical component of that is that Rob and the subsequent two ESG focused analysts that we've hired, their titles are research analysts. They sit on the investment teams. Their job is to make all of our colleagues on the investment teams better at what we do. And they're not some separate entity that sits off and creates ESG research, which, as I mentioned, is really critical to how we think about doing this. So in 2017, we created the Sustainability Group, which is different than the Responsible Investment Committee. The Sustainability Group is made up of senior leaders from across the firm, and really sets the strategic direction of how we approach sustainability and ESG work. And so I guess I'll just round it out by saying, I mentioned we've got two more ESG focused analysts. One is an equity analyst in Singapore, and one is a fixed income analyst that joined us last year, and he sits in Boston as well. So happy to dive into any part of that you'd like, but that's the brief background.
No, that's great. Thank you. As the approaches evolve, clients, I'm sure you're hearing, are asking lots of different kinds of questions. I know I'd be curious to just hear, what are the most provocative questions your clients are asking you today, and how is that perhaps shaping, how both the changes you might have made, but also what you might be thinking about, in the coming couple of years?
Sure. I guess maybe the big category for that would be just the idea of divestment, based purely on kind of a value-based approach to sustainability investing. And it's not wildly provocative, but it does tend to lead to good dialogue, actually, between ourselves and our clients. As I mentioned, we view sustainability as critical to providing the best long-term risk-adjusted returns for our clients as we can. And so we think that that we're always going to have that fully integrated. That doesn't necessarily mean divesting of any company that isn't pristine from a sustainability perspective. On the one hand, I'm not sure how many companies would fit that category anyway, but we can certainly imagine companies on the far other end of the spectrum. And we tend to be underweight or naked those companies in our equity portfolios for the most part, but it's not because they're on an exclusion list or something like that. It's because we are long-term investors, and the sustainability challenges of some of those companies and industries are such that we wouldn't own them, but we do own some in some portfolios, and importantly, we see engagement as critical, both to getting our portfolios where they need to be, but also to advancing where we are in the world. That so just walking away from a shareholding can have some impact, but really engaging with the management teams that that we invest in, we think actually can have more impact, both for the companies, for our portfolios, and for the world.
It's interesting. I just want to pick up the beginning of your comment. You made your, divestment and value, where very often people think about divestment as linked to values, not necessarily to value. So just to make sure I caught it correctly, it sounds like you might be seeing more requests for divestment or questions for divestment from a long-term value conversation versus this is just a category or an industry that doesn't align to my values or the values of our stakeholders.
Yeah, sorry about that. As a Bostonian, sometimes I drop my R's. I guess I dropped an S there because I did mean values. That we think value is how we approach it, right? So those are not provocative questions with our clients at all. How this relates to the value of a company, where it's purely a values discussion leading to a divestment, purely on that basis is where we are less likely to go.
Yeah, no, great. Good. Well, thank you. A couple sort of more, maybe even continually sort of newsy topics. Can't let this go without talking about COVID, obviously. And as you well know, as probably everyone on the line knows, COVID has sort of shone a new light on questions of sustainability. I know, particularly in March and sort of early April, there were arguments that we should be turning our attention away from responsible investing. Sort of it was a distraction, but others have actually argued that COVID has sort of amplified some of the reasons why responsible investing is so important. So just curious kind of how you're thinking about this, has your thinking evolved over the last 6 months or so, and just kind of interested how you're thinking about sort of COVID meets responsible investing.
Yeah, we're definitely in the latter camp. We think it has shown light on where there needs to be, or there's the potential for more focus. I think importantly, I think a lot of investment managers on the sustainability ESG journey, probably the easiest and most natural place to start is on the G side, and I think we and a number of other firms probably made the most progress there in the early days. The E and the S side are ones that we continue to try to think more creatively about how to approach them and how to integrate them. And I think on the social side, COVID really brought into focus things that we were fortunately already working on and paying a lot of attention to. So if you take just the retail space, I'm not going to get into company names, I'm sure you can appreciate that, but companies that took the approach of spending the money to keep their employees safe while also providing critical services to their customers, those are companies that we think are just going to be more sustainable through any environment. This made that crystal clear. And what was really interesting as we engaged with companies on this is the number of times that some companies actually were defensive when we'd be asking them about giving increased pay to employees to compensate them, doing things that would definitely hit gross margins in the near term in order to protect their employees and protect their customers. They assumed that we were being critical and trying to be what gives sometimes the investment management industry a bad reputation of looking to maximize near-term profit at the expense of either society or long-term profit. And we had to explain to them, no, we actually think that you, a company that is investing in your people, in your customers, in a safer world, that's what we want to see. And actually, we think that that's going to drive more sustainable earnings, higher multiples over time. So it was even interesting just to watch the companies that were doing the right thing just assume that we were not interested in sustainable investing, and not just us, but that the industry in general.
That's interesting. It either suggests that, at your earlier point, kind of maybe the industry's garnered a bad reputation on these things, or maybe they were being asked, from the opposite angle by other investors. So kind of that's an interesting comment. Do you think that, given there's a history that made somebody act defensively, or a particular, set of people act defensively, do you think kind of, I'll call it sort of more ethical human capital management, so to speak, is kind of here to stay in the post-COVID era? Or do you think, maybe we'll return to perhaps, some of the reasons why the companies might have responded defensively?
Yeah, I don't know. I mean, I suspect it'll run the spectrum as it always has, right? I suspect you'll have companies, investors, management teams that are short-term focused and not interested in sort of doing the right ethical, sustainable thing over the long term. And I think that our view obviously is that over the long term, those companies will not be rewarded as well as others. But I think humans are humans, and I tend to think that most humans are inherently good and good at maximizing long-term benefit of the world. But there'll always be bad actors, and in a way, sort of that's good news for good active managers to be able to separate the bad actors from the good actors, the visionaries from the near-term profit maximizers. So we'll continue to, I was going to say, come into work, log into work every day to try to make those separations.
Yeah, good. Well, in the spirit of keeping us all safe, we'll log in. Another topic I just wanted to bring up, obviously, is climate, which is another one of the big ones. Earlier this month, I'm sure you saw Climate Action 100 Plus, which for those on the phone that don't know, it is a network of about 500 or so global investors that manages, many trillions of dollars. They wrote to the top emitting companies asking them to detail their plans for net zero. In a similar vein, I know the CDP, the Carbon Disclosure Project, is also planning a pretty aggressive engagement campaign to top emitting companies as well. Interested how you think about net zero portfolios, what this transition should look like, how investors should sort of prepare, what advice you're giving clients on that. Just would love to sort of open up that conversation.
Yep. So I mean, as we stand in 2020, I think a net zero portfolio is a good example of sort of an extreme approach that isn't applicable to a diversified portfolio today. But the organizations that you mentioned and some of the more thoughtful approaches to these are not necessarily arguing that we get there today. They're arguing for a plan to get there in a more reasonable future, which we completely support. So we're always careful of what and how we sign on to things. We want to make sure first and foremost that we can always deliver on it, and that we're not trying to sort of sign on to the flavor of the month that might give us a good headline. I think, as I mentioned earlier, constructing a net zero portfolio today that's truly a broadly diversified portfolio would be, we think, nearly impossible. And importantly, some of the companies that we own that we think are amongst the most sustainable businesses that are driving sustainability in their industries and in the world are not net zero. And particularly when you get its scope 3 emissions, some of the real like I said, the companies that are really driving positive change have not a problem with scope 3 emissions, but tend to have reasonably high scope 3 emissions. And that's part of why they can have so much impact as they work through that and get their value chain optimized for their business and for the world. But that's not something we don't think that you can snap your fingers either as a company or as an investment manager and get to tomorrow. So it's all in the rubric of what we think is exciting and why we think we're particularly well positioned to invest sustainably, is that it's not simple. It requires really diving into a lot of varied variables and getting to the right answer for the long-term value of the businesses we invest in.
I'd be curious sort of the advice you would give to sort of capital allocators or owners that are starting to ask questions about this. I certainly know from other endowments, colleagues, and other asset owners that often board stakeholders are sometimes asking questions, sometimes pushing more aggressively toward net zero. So sort of interested what advice you would give to to an asset owner who wants to take the right steps at the right time, because this is, I sense, will be something that moves slowly till it moves quickly. And investment organizations don't always move quickly. So just kind of interested what advice you would give, what steps you would say that a sort of responsible owner should be thinking about and taking as we sort of look to a decarbonization trend growing in the future.
I mean, I guess the first one would be just make sure you're being fully thoughtful and cognizant of all of your stakeholders, right? When we talk about sustainability, we talk about stakeholders and the fact that maybe historically shareholders of public companies have been over-focused on, and particularly short-term shareholders at the expense of other stakeholders. I think one thing as an asset owner you would want to be careful of, I would think, would be to make sure that you're not, again, imposing value decisions that maybe are at the expense of what is in the best interest of your stakeholders and the folks that, to use an example, if you're running a pension fund and you're one of your major responsibilities is to make sure that your pensioners are going to be able to earn what they have earned over the long term. To do something that would jeopardize that would clearly be suboptimal, but that, in our view, does not need to be in any way in conflict with investing sustainably and then ultimately thinking about a net zero world or portfolio. But it does bring it back to the time frame and the appropriate actions between here to there. And I do think that if you took too extreme an approach and too extreme a time frame, you would put your primary purpose at some risk, I would argue needlessly, because you can get to the ultimate goal in a more sustainable and gradual and cautious way.
Great. Well, thank you. The challenge many of us, I'm sure, are facing. So I have a couple more questions, and obviously I'll just reiterate, Ted and I would both welcome any sort of questions from the audience at any time, so don't hold back. Another sort of favorite ESG topic is data. And I feel like it's kind of complaint number one anytime that ESG, sustainability, responsible investing people get together. So would love to just sort of pick your brain on this one a little bit. Back to the sort of journey, data is evolving, as we all say, and ESG ratings are all over the map. The sources of data are, people are innovating in that space, shall we say. So curious if you could just talk a little bit about sort of, interested broadly how you think about data, but just the sort of utility of some of the external ratings that you no doubt have analyzed, and sort of what advice you would give. Well, maybe you could talk about the ratings first, but then we can maybe talk about the best way to really and truly assess companies' ESG performance.
Sure, I'll be a little bit careful how I respond to this. The ratings, we think that the companies that are providing the ratings are doing the best that they can and providing a real service for us, but ultimately for our clients, maybe more so than us. But we also tend to disagree with the actual ratings in a lot of cases, which we actually think is another reason, is a positive for our business and for our industry, because this is hard. And if it were easy to bat for a really high average on any kind of rating, including sustainability rating, then it would be easy, and we wouldn't have an interesting and valuable profession to work in. And so we do worry a little bit about just looking at a portfolio and saying it's this third-party rating agency rates the portfolio highly. I think we stand in a pretty powerful position to publicly worry about that, because if you do that, our portfolios tend to score extremely well relative to our large competitors. And so on the one hand, we're proud of that. On the other hand, we get a little bit nervous because we don't necessarily agree with the underlying ratings philosophy that gets there. So because of that, it could change in a way that we would think we're being just as sustainable and focused on this as we always have been, but the ratings go the other way. So then it comes down to the data, as you say. The firms that do these ratings have great access to data, and they've actually been quite open to giving us direct access to the data. And that's how we think we'll add the most value to our clients, is by doing what we do, which is taking as many inputs as we think are relevant to driving stock and bond performance, and analyzing them ourselves, and using them in the wide rubric of work that we do to try to get to the right investment conclusions for our clients. And so that's really our focus. We have shied away from having our own internal ESG rating system because we do think it runs counter to our philosophy of our rating on a security should be a sustainability rating, right? We're long-term sustainable investors, and so to somehow have a separate rating from the primary buy, sell, hold rating is one that we've had a lot of debate internally over the years, and so far we've held the line on not having a separate sustainability rating, but it comes up all the time, and for good reason. It's a good discussion that we're glad that we have. But what we certainly don't want to do to bring it all the way back is to be reliant on a third-party rating as any sort of proof statement for how we do this.
It just your comment there at the end reminds me of a discussion I often have internally with my colleagues, which everybody wants RI integration, but by pulling out and having a sort of separate section that analyzes this particular set of characteristics, it actually oddly serves to de-integrate
Yes.
what might have already been integrated and not just bluntly sort of maybe communicated as such. So I know that's certainly something I don't wrestle with it. I completely understand it. But when there's external expectations and demands around how things are communicated, it's certainly not easy to figure out exactly the right way to kind of get it all together.
Yeah, it's tough. You and we need to demonstrate the work that we're doing here, right? And we're fine with that. We're good with that. But then as soon as you do that, you bring up the challenge that is there, which is that now you are on integrating. And so it's we think everyone is thoughtful in the space and understands the tensions there, but it's also something that we try to be pretty vocal about highlighting those tensions.
Yeah, no, absolutely. Well, maybe just a kind of final question from me, and then we'll sort of pick up on any questions that may have come in. Just kind of, you've mentioned a couple, well, actually maybe two more questions for me. You've mentioned a couple times about the commitment to long-term investing you have at MFS, and you and I both share an involvement with Focusing Capital in the Long Term, which is an organization based out of your hometown in Boston. Curious if you can comment a little bit. Oh, I don't know if that was your hometown, but where you live now. Yeah, okay, well, there you go. So just kind of curious if you can talk about, if you see a distinction between responsible investing, sustainable investing, and long-term investing, and if so, sort of what is that distinction?
We don't, and I think that is the critical approach that we take to resolving all of that, which is that we do think that over the appropriate time frame, a time frame that we've long been focused on, certainly for our equity clients, that you must be sustainable, you must be responsible, and that said, it's a pretty long time frame, and so we work really hard just because we think it's the right thing for our long-term risk-adjusted returns. We work really hard to set up lots of tools and structures internally to make sure that our people are actually doing something that's incredibly unnatural for human beings, which is to be very focused on the long term and try to block out all of the short-term noise that's out there. With our brains, we're programmed to run away from the lion in the forest rather than think thoughtfully about what a company is going to look like 10 years in the future when you've got blinky green and red lights in your face all day. And so we do think that if and as we do that and continue to structure our organization and our approach for our clients to be very long-term focused, it all comes together. But that's a really passive comment on my part. It all comes together. I mean, it takes a lot of work and it takes a lot of focus, and I don't think it would just come together unless we did all these other things that we do with respect to sustainability and ESG integration, and making sure that we're being very intentional about that, and driving that, but having our primary focus on that be this long-term focus that brings it all together.
Well, that's actually a good tee up for one of the questions here, so I'll save my last question for last. But hindsight sort of being 2020, there's been lots of journeys and steps and missteps along the way on people sort of trying to get this kind of ESG integration right. If you were to sort of look back over the last decade or so, are there things that we I don't want to pick MFS, maybe the industry, or you MFS specifically, or you saw that were like just bad ideas? So the question is more about kind of things that maybe we shouldn't have done that we spent a long time on, and that maybe for people who are earlier in their journey might want to avoid.
Yeah, I mean, like I said, I'd be really hesitant to use the expression bad ideas, because I think the reality is that there's going to be very different approaches, many of which can be successful. And that's just, I think, a comment I could make about investing, but certainly sustainable and responsible investing. So, maybe I will speak for us, things that we saw that we very intentionally didn't do, but that we considered, right? And one is, do you have ESG or sustainability product, right? And that's very similar to the comment that I made about sustainability ratings, right? In that there was a lot of pressure externally to do that. I think there still is, and we get it, and that might be the right approach for some, but for us that would have been a big mistake, because it would have taken away from the core of what we do, which is invest sustainability across all of our strategies. And so I think that's one specific example into the broader thing where I think where you can make mistakes is when you it comes back to actually how we want the companies we invest in to operate. I think where you make mistakes is when you do things that seem like they might benefit your business for the short or medium term, but aren't necessarily benefiting your clients for the long term. So, you know, we're really proud. One of the things that we're proud of that doesn't sound like it has to do with sustainability is how we've managed capacity at the firm. So we've closed a number of strategies over the years at asset bases well below where our competitors have continued to take in assets. And our view is that we can calculate how much profit for our company we left on the table by doing that in the near term. But we have this guiding light that if you do the right thing for your clients over the long term, it will be the right thing for your business over the long term. And so there's such a so many pressures to try to just do ironically, to sort of do the quick, easy thing on the ESG and sustainability front, when the best thing that we think you can do is actually fight those pressures and do the right thing for the client, which we think is also the right thing for the planet, and be thoughtful about how you're doing over the long term.
Very sustainably said. Good. Well, last question is really just kind of an eye to the future. So just curious how you see sustainable investing evolving, and kind of where you predict the industry may be, let's say 3 to 5 years from now.
Sure. I mean, I think it's the same way I think we see investing evolving, right? The world changes. One of the things that I've always loved, I've spent my whole career in this industry, one of the things that I've always loved about it is also one of the challenges of it, which is that the world changes every day, right? You come in, or now you come downstairs to your office and turn on the machines and see what happened. And you know, your job is to integrate that into how you're trying to manage money for clients. And so I think this is no different than that. And so it'll continue to evolve in probably unpredictable ways. But we touched on some of that. I think just like in any other industry or any other industry trend, there'll be lots of innovators, and a bunch of them will fail. But we think one of our keys for success will be to make sure that we're being thoughtful about how we integrate third-party work, startups that are taking novel approaches with real specialization, and just making sure that we're doing what we always do, which is giving our people the tools that they need and the constructs that they need in order to drive value for our clients over the long term.
Great. Well, thank you. This has been a really enjoyable discussion, at least for me, and I'm sure for everyone on the line as well. Caroline, I hope I've done my job in moderating us to right up to time, leaving you 2 minutes to take us home. So just on behalf maybe of Ted and me, thank you.
Well, I couldn't be more pleased. You did a fantastic job, as did you, Ted. I want to thank you both for your time and your insights. I'd like to thank everyone who tuned in today for their time, and I certainly hope they enjoyed today's session. Don't forget to keep an eye out for our next Monday Minute coming later this month. And please, everyone, have a great day. Thanks so much.
Thank you.
Thank you.